Welcome to our March 2026 video on tax strategies. Basically, this time of year is all about the tax preparation and filing the tax returns. But we also need to make sure that we're doing some tax planning. They're two very different things. There's the preparation of the reports that already happened, and then the planning focuses on, the decisions that could improve future outcomes.
Yeah, a lot of strategies really can make a big difference. And they can be fairly simple, but they're often just overlooked in the heat of trying to have your returns filed. So today we're going to spend some time going through planning ideas that are commonly missed, and of course how they impact your broader financial plan. And the one that, we talk about this a lot, retirement contributions. It's extremely important that you're taking advantage of these retirement accounts, not only because it's going to have an effect on your future outcomes from a retirement planning perspective, but also because they can be particularly good tax strategies as well. So your traditional contributions are going to reduce taxable income today. And then obviously Roth contributions are funded with after-tax dollars, but can provide tax-free income later on.
And then depending on income amounts, you might have to do backdoor Roth contributions. And those are conversations that we have with clients. And the idea is to build up your tax diversification buckets. So that way future income comes from, different places. And I think that has a real positive impact in retirement. The other one is tax efficient investing. It's overlooked, but each type of account is treated differently when it comes to taxes. Taxable brokerage accounts, you have dividends, you have interest, you have capital gains. Traditional retirement accounts, it's all taxed as ordinary income. And then Roth, it's after-tax money, but it's tax-free withdrawals. They all follow different tax rules. It's important to know those little nuances.
And at the end of the day, it's where the investments are actually located, and we call this asset location. And it can influence the long-term tax efficiency of the overall plan. So coordination is very meaningful. The third one that we want to touch on here is health savings accounts, or HSAs. For people who qualify for these, they're a very, very powerful tool because they offer a unique combination of potential tax advantages. The contributions can be tax deductible, the growth is tax deferred, and qualified withdrawals are tax free. So something to be aware of.
I would say, use strategically. HSAs can be an important part longer term because it keeps on rolling over every year. So it's not like it has to come out. So we have a lot of retirees that still have their HSAs that they're using to pay for different things in retirement. The next point, tax loss harvesting. Unfortunately, last year we didn't have much of it, but it's something that we're constantly looking at as far as where can we try to offset some of the potential capital gains that clients may be incurring?
Timing and coordination matter, right? We've seen some volatility the past couple of weeks here. It's not something that you should just automatically do. It needs to fit the overall plan and strategy. Number 5 that we wanted to touch on here, charitable giving strategies, also very powerful. For people who regularly give to charity, there can also be tax efficient ways to structure these gifts. A couple of examples are donor advised funds. We're seeing more interest in that lately. And then qualified charitable distributions. For those of you over 70 and a half, this is something you might want to be considering if you're charitably inclined.
Yeah, I would say it checks both boxes. One, you get to support a cause that you might be, inclined to support anyways. And then the second thing is you're also managing your taxes more thoughtfully and strategically. So those are two important things. I would say also withholdings and cash flow. Make sure you have the right tax withholding. You don't want to have a huge refund at the end of the year. You also don't want to add a large amount that you have to pay because it comes with interest and penalties. So trying to avoid those things are important.
Things like income changes, bonuses, family changes, new kids, etc. All that's going to affect your withholding and your ability to take different deductions. And believe it or not, we're almost a third of the way through the year here. So it's important to review these potential changes now. That way you're not trying to play catch up later or dealing with the consequences next year. A couple of common filing mistakes, and this is our 7th point here. During tax season, it's important to make sure that you're filing your return with all of your documents. We've seen people miss documents, and then you have to go and amend the return, and that's a big headache. Incorrect beneficiary designations. information, I should say, and then overlooking contribution opportunities before filing, taking advantage of those IRAs and Roth IRAs.
To wrap it up, a little organization and planning ahead of time can make a huge difference and make the whole process go much smoother. The main takeaway is it's a proactive approach that you need to take, really hurt you in the end. So
absolutely. If you're reviewing your taxes right now, it's a really good opportunity to take a step back and look at how these decisions fit into the overall plan and just make sure they're coordinating.
If you ever want us to look at your tax situation, we'd be happy to. And we'll see you on the next video. Thank you.